Now is a really great time to think about having the discussion with your investors about alternatives. I think on one hand, it's a challenging conversation because we've had a huge run up in stocks. Even bonds have done very well. So it's a challenging conversation to have, but it's because bonds have done well and because stocks have done well, it's a great time to think about adding ways that I can perhaps hedge my equity exposure because we maybe are at the top end or maybe a slightly overvalued component for equities at this point. So it's time to think about maybe reducing some of that risk. On the bond side, it's a little bit more important because we're coming off of a very long run for bonds, about a 30-year bull market. And for bond investors, it's going to be a much harder conversation because they've really enjoyed a very long period of low volatility, excellent returns. And so now they need to think about what types of alternatives can I use to hedge some of the risks from a rising interest rate environment, from a sideways moving environment with probably some added volatility and the potential for loss. You have to think about how do I hedge out some of those risks. And it's a good conversation to start now, maybe adding a little bit of alternative strategies to get people used to it, and then growing that allocation over time will ultimately, I think, result in a better portfolio for investors. In trying to come up with an allocation, it really sort of depends on the client and the advisor relationship that they have. I think it's good to start with a range of maybe between 5 and 20%, being at the upper end of that. And if you've got a client who's kind of a prolific CNBC watcher, maybe whenever the S&P is up 1%, they're going to log into their account, see if they're up 1%. That's probably someone you need to start out a little bit smaller with. Get them more used to it, help them understand the concept, and over time move them a little bit higher. If you have a client who's a little bit more open about their portfolio construction, is a little bit worried about maybe equity or bond risks, that might be a client you can maybe put a little bit more in, maybe start with 10% and over time add to it. But the other thing is you don't necessarily need to always be at 20% or always at 5%. You can move it around based on what maybe your opinion is about the market or maybe what the investor's opinion is about the market as a way to kind of add a little bit of extra value.